Rent vesting gets called a compromise, but for a lot of financially literate Australians, it might actually be the sharp of life. To start with the framing, because it matters. Rent vesting, the strategy of renting where you live while owning an investment property elsewhere, tends to get discussed in one of two ways. Either it's promoted as this clever financial hack that lets you build wealth while enjoying amenity you couldn't otherwise afford, or it's dismissed as a compromise that means you never really own your home and are always at the mercy of landlords. Both of these framings are reductive. The reality is that rent vesting is a strategy with genuine advantages and genuine risks. And whether it's the right call depends entirely on the specifics of your financial situation, your life circumstances, and your investment goals. It is not universally smart and it is not a compromise by definition. What I want to do in this video is give you the actual analytical framework for evaluating rent vesting as an option. So you can make a genuine informed decision rather than one driven by how the concept feels. Let's start with the financial mechanics because that's where the case either holds together or falls apart. Core logic of rent vesting is about capital allocation efficiency. When you buy a principal place of residence, you're deploying a significant amount of equity, typically a 20% deposit plus cost, into an asset that has genuine value but sits outside the investment portfolio structure. The tax treatment of your home is different to an investment property. You get the CGT main residence exemption, but you also don't get the negative gearing deductions, the depreciation, the tax treatment of the holding costs. The rent vesting hypothesis says, what if instead of deploying that capital into an owner occupied property in a location you want to live, which may or may not be a strong investment market, you deployed it into an investment property in a market with stronger fundamentals and demand supply indicators, and rented the lifestyle property that you would otherwise have bought. Comparisons you want to run is what does your capital do in option A versus option B? Not in terms of how it feels, but in pure financial terms over a 10 to 15 years horizon. There are several variables that drive this comparison. The first is the yield differential. If you can rent the property you want to live in for significantly less per week than the holding cost of owning it, which is often the case in high density urban markets where rental yields are compressed relative to purchase price, then there's a real financial gap between what you're paying to occupy the space and what you would be paying to own. That differential represents capital you can deploy elsewhere. The second variable is the relative investment performance of the two assets. If the property you would be buying as an owner occupier has weaker fundamentals than the investment property you would be buying in a different market, the investment path may produce better total results, even accounting for the fact that you're not building direct owner occupier equity. The third variable is the tax treatment. Investment property interest is generally deductible in Australia. You can claim depreciation on plant and equipment and potentially on building structure if it's new enough. The cash flow position of the investment property after accounting for rent received, interest, and all deductions may be meaningfully different to what it looks like on the surface. I want to be clear here that this is not tax advice. Your specific situation needs to be modeled by a qualified accountant who understands your income profile, your other investments, and your marginal tax rate. But the tax variable is real and it belongs in the analysis. So if you're at the rent vesting decision point and you want to work through the financial case for your specific situation, including how it might interact with the buyer's agent engagement, that's exactly the kind of conversation we have in our discovery calls at OB Property Buyers. No obligation, link in description below. Now let me give the other side of the ledger equal weight because the rent vesting risks are real and they're often underplayed in the content that promotes the strategy. First risk is serviceability trajectory. When you have used your borrowing capacity on an investment property and you later want to purchase an owner-occupied home, your borrowing position will have changed. Lenders will assess your existing investment loan obligations when calculating your capacity for the new loan. Depending on how your income has grown and how much equity you've built, this can either be fine or it can be a meaningful constraint. It's not a reason to rule out an investing. It's a reason to model the future financial path carefully, not just the immediate one. The second risk is the emotional dimension. Now, I don't want to dismiss this. For many people, owning the home they live in is not just a financial decision. It's a stability decision. It's a family decision, an identity decision. Renting means you can be asked to vacate at the end of a lease. It means you can't renovate without landlord approval. It means the place where your kids grow up can change. For people with strong preferences around those things, the financial case for rent vesting has to be quite compelling to outweigh the emotional cost. The third risk is execution. The rent vesting strategy only works if the investment property you buy is genuinely well selected, structured for strong demand, appropriate cash flow, and genuinely long term resilient. If you rent your lifestyle and buy a mediocre investment property, you've got the worst of both worlds. The investment hypothesis has to actually hold up. Here's where I land on rent vesting as a strategy. For financially literate investors with the discipline to make a genuinely good investment property selection, adequate buffers to sustain the holding position, and either low attachment to owner occupier stability or specific circumstances that make renting sensible, rent vesting can be a structurally sound approach, not a compromise, a choice. For people with strong emotional needs around home ownership, families with school age children who need location stability, or investors who aren't confident that they can make a rigorous investment property selection, the owner occupier path may be more appropriate, even if it's not optimal on a pure capital efficiency basis. Honest answer is that this is a deeply personal decision that lives at the intersection of finance, lifestyle, and values. Get the financial modeling done properly. Have an honest conversation with yourself about the non financial dimensions and make the decision from a genuinely informed position. That's the only way to make a decision you'll still stand behind in 10 years.